The next set of ratios we're going to talk about now, these are activity ratios. And just in my experience, I think students have a harder time understanding activity ratios than they do the other types of ratios. Now, activity ratios measure how effectively the firm is utilizing its resources. As we talked about earlier now, the resources of the company now, we're talking about the financial resources of the company. We're talking about the assets of the company and their ability to generate goods or services that somebody wants to buy. So we're talking about the ability of the assets to generate sales. As you look at each of these activity ratios, you'll note that sales is a major component, and indeed usually is the numerator in the equation. Now the first one we're going to talk about now, this is total asset turnover. And total asset turnover is defined as sales over total assets. So you would take this number right here and divide it by the total assets off the balance sheet. And let's say that this turned out to be 6. Now, what does 6 mean? Now, often there's a little X behind the 6 and people say, well, that means that sales are 6 times the size of total assets. And that's true enough. I don't like the little X business. I like to think of it as a dollar. You're generating $6 in sales for every $1 you have invested in total assets. All things being equal, you'd like that number to be what? To be higher as opposed to lower. You'd like to generate more sales for every dollar you have invested. And again, it's called total asset turnover. If you compare this to some industry average, and the industry average were 8, that means the typical firm in the industry is generating $8 in sales for every dollar in total assets. You're only generating $6. You're below average. What's the cause of that? Well, you don't know. Total asset turnover doesn't really give you that answer. And as you look at the balance sheet here, we're going to start with total assets and then we're going to work our way up the left-hand side of the balance sheet. The next asset that we look at now, this is going to be fixed assets. And indeed, we're going to calculate what's called fixed asset turnover. This is sales divided by net fixed assets, not gross fixed assets, net fixed assets. Now, if this turned out to be 9, that means that you're generating $9 in sales for every $1 in fixed assets. If you looked at the typical firm in the industry, they might be doing $12. Again, this firm's ability to generate sales off their investment in fixed assets is below that of the typical firm in the industry. Again, what do you do about this? Well, we haven't really got to the answer yet, but fixed assets could be a problem. We don't know yet. As we move up the left-hand side now, we're going to get into the current assets section of the balance sheet. We're going to do inventory turnover, and then we're going to look at receivables, 2 other assets. Inventory turnover is defined as sales divided by inventory. And if this turned out to be 14, that means you're generating $14 in sales for every $1 in inventory. The typical firm in the industry, they might be generating $16 in inventory. What could be your problem? In practice now, you don't solve problems by sitting in your office and reading a computer terminal. You have to get up, go out to wherever the problem is and see what's wrong with it. If it's an inventory problem, go see your inventory. You go out there, all the shirts are blue. You might want to get some white shirts and brown shirts and whatever. You might need a different mix of inventory. Could it be that your salesmen aren't working hard enough? They're playing too much golf, talking on the cell phone, whatever? Yeah, it could be. Maybe you need to flog the salesman. But something's wrong with inventory. At this point, this is what you're thinking. And the way you solve these problems now is not looking at your computer, but going out where the issue is. In this case, if you think it's inventory, go see what the problem is. Average collection period. Now, most people don't think of accounts receivables as being kind of an asset that generates sales. But indeed, receivables now, and the level of receivables, it kind of reflects the terms you're offering to your clients, to your customers. Increasing sales follows easy credit. You know, at the end of the year now, when the Ford dealer wants to get rid of all the Tauruses or whatever it is, they're going to say, you know, no credit, good credit, bad credit. Come in, we'll sell you a car, and we'll finance it for you. Very lenient credit. If you have very stringent credit and your competitors down the road have very lenient credit, they're going to have more sales than you do. So sales follows easy credit. And an average collection period, sometimes called days sales outstanding, this is a look at the credit policy of the company. If you calculated this for your company and you got 30, that's really 30 days. And what that means is that for your typical customer who comes in to do business with you, they take your inventory, they walk up to the register, they say charge it. You don't see any cash for those sales on average for 30 days. All things being equal now, you prefer this number to be what? Smaller as opposed to larger. And indeed, if the industry ratio was 60 days, a lot of us would look at that and think, well, this company's doing a better job of collecting receivables off sales than is the typical firm in the industry. The other problem, though, is that you're giving your customers 30 days to pay, your competitors are giving them 60 days to pay. In town here, there's a number of places where contractors go buy stuff to build a house, 2x4s and whatever. If one business is giving them 30 days to pay and another business is giving them 60 days to pay, they're going to go where they get easier credit. They're going to go buy more stuff down there from the guy that's giving them more lenient credit. As you look at this company now, the problem may indeed be their receivables, their credit policy. They have too stringent a credit policy. If they made credit a little more lenient, that is, if they made it a little easier to get, better credit terms, all the rest, if that happened now, sales would go up. And if sales went up, what would happen to all these ratios? They'd all go up. And indeed, they would all fall into line then, which is, you're looking for the solution to the issues here. So again, sometimes it's credit policy. It's not lazy salesman. It's not that your fixed assets aren't a proper investment. It could be credit policy.